Every quarter, JP Morgan releases its guide to the markets, which covers a ton of interesting market data, such as the S&P 500's valuation, international stock valuations, projected future earnings growth in the S&P 500, interest rate projections, and so much more. And every quarter, I go through all of this key data here on my channel. So in today's video, we are going to go through JP Morgan's newest report that was just released, and I will update you all with my thoughts on if the market is looking like it is in a bubble, expensive, or even cheap today. However, before we get into the video, I want to let you all know that I will be at the Blossom social event in Toronto on June 25th. I was invited to be a speaker on a panel at the event, and I will be hanging out there all night. So if you would like to come and meet me in Toronto, then you can go and get your tickets to the event on Eventbrite, and I will leave a link in the description of this video below. It is going to be a huge event with about 600 investors coming, so it will be a great chance to network and meet some of your favorite content creators. Oh, and if you have a copy of my book, The Fundamentals of Investing, then bring it along, because I would be happy to sign your copy if you do have one. And with that being said, let's hop right into it. All right, so this is the first slide right here of JP Morgan's guide to the market. And it shows us that the market is currently trading for a forward price to earnings ratio of 20.5. Now, if we compare this to history, we can see that in 2022, before that large market correction that we got, the market was trading for a forward price to earnings ratio of 21.4. And back in the tech bubble, the market was selling for a forward price to earnings ratio of 25.2. So currently the market, at least on a forwards price to earnings ratio basis, is actually slightly cheaper than it was in 2022 and quite a bit cheaper than during the tech bubble. Now, what's also interesting to note is that the 10-year treasury or the bond yield was 6.2% in the year of 2000. This combination right here of a forward price to earnings ratio of 25.2 and a 6% government bond yield suggests that the market was very expensive in the year 2000. And the reason is because a forward price to earnings ratio of 25.2 is an earnings yield of only 3.96%, which means that stocks were yielding significantly less than government bonds at that time. However, the market today is offering a forward earnings yield of about 4.88% if we want to round up, which is actually above what 10-year treasuries are currently offering. It's only slightly above, so the market is kind of yielding roughly what a 10-year government bond would, but it does suggest that the market is actually cheaper, significantly cheaper than it was in the year of 2000, and therefore I do not believe that the market is currently in a bubble. It is looking expensive to me, but it is not in a bubble. So now let's take a look at the price to earnings ratio of the S&P 500, and it is currently sitting at 27.86, which is quite high relative to history. Again, it's not quite as high as during the tech bubble, but it is up there. So the market is looking quite expensive, at least in my own opinion, and relative to historical data. Moving on to the next slide, this one shows us the 1 and 5 year future returns historically when the market has traded for a forward price to earnings ratio of 20.5. And on the left-hand side, we can see that the 1-year returns are quite low at about 3%. And on the right-hand chart, we can see that on average, the 5-year returns of the market when it does sell for a forward price to earnings ratio of 20.5 is basically 0% or even slightly negative. What's also very interesting about these charts is you can clearly see that the more expensive the market becomes, the less future returns investors can expect. And we can see that by this orange line clearly going down as the price to earnings ratio of the S&P 500 goes up. And this is why I focus so much on paying the right price for stocks in general here on my channel. There's a lot of people out there and a lot of investors in the market right now that seemingly don't really care about the prices that they are paying for stocks because stocks have just continued to go up as a whole, no matter what price people have really been willing to pay. So at least recently, you can pay a high price and you have been rewarded with a return in the short term. However, throughout the history of the stock market, when you do pay a very high price for stocks, your future returns are quite low. And I do think that we probably will see lower returns over the next 5 years of the S&P 500 because the price right now is pretty high. And the historical data does suggest that investors should lower their expectations for future returns from today's prices. Moving on to the next slide, this one shows us what analysts are projecting for the S&P 500's earnings per share growth over the next 3 years. And we can see that in 2024, they are expecting 11% growth. In 2025, they are expecting another 14% growth. And then in 2026, they are expecting another 12% earnings per share growth. So analysts are basically expecting double-digit growth rates to the S&P 500's earnings annually over the next 3 years. Now, what you can do is ask yourself if you think that this is too optimistic or even too pessimistic. In my opinion, this is actually pretty optimistic based on where everything currently is. But who knows? Maybe interest rates will decline significantly, and that will cause a tailwind for earnings over the next 3 years. But these are the numbers that the market is currently factoring in, and this is what analysts are currently expecting for the growth of the S&P 500 over the next 3 years. All right, moving on, this next chart on the left-hand side of this image shows us the relative valuations of growth stocks versus value stocks. And currently we can see that value stocks are actually looking cheaper than growth stocks. However, if we take a look at the table at the bottom here, we can see that value stocks are currently trading for about 15.6 times earnings, and their long-term averages have been about 14.1 times earnings. So even value stocks are actually trading about 10% above their historical averages and are not actually looking super cheap. Now, if we take a look at growth stocks, they're currently selling for a 27 multiple, whereas their historical average is 21. So growth stocks are looking even more expensive and trading about 30% above their historical averages. So overall, it does look like both value and growth stocks are a little bit more expensive than they have been historically. It's just that value stocks are not quite as overvalued as growth stocks in the market right now. That is kind of what this chart is trying to say here. This next chart shows us the price to earnings ratio of the top 10 stocks in the S&P 500 and then the remaining 490 stocks within the S&P 500. So currently we can see that the top 10 stocks are trading for a forward price to earnings ratio of 28.1, and their historical average has been about 20.4, which suggests that these stocks are trading about 38% above their historical averages right now. The remaining 490 stocks are trading for a 17.6 multiple, whereas their historical average has been about 15.7, so they are trading about 12% above their historical averages right now. Then the S&P 500 as a whole is trading for 20.5 times earnings, and its average has been about 16.5. So as a whole, the S&P 500 is trading about 24% above its historical averages. So the top 10 stocks at least look like they are the most expensive in the market right now. And then the remaining stocks are actually still trading above their historical averages too. So overall, it does look like the S&P 500 as a whole is on the more expensive end today. The next chart shows us the weight of the top 10 stocks in the S&P 500, and currently the top 10 stocks make up 35.4% of the total S&P 500, which is actually at about a 30-year high right now. In the tech bubble, the top 10 stocks made up roughly 26% of the S&P 500, so the top 10 stocks today make up a significant amount of the actual S&P. And the S&P is becoming more and more concentrated within just a handful of stocks. However, it is worth noting that the top 10 stocks in the S&P 500 make up 27% of the overall index's earnings. So these top 10 companies are actually producing more than a quarter of the S&P 500's earnings as well. So they do deserve a pretty large weighting in the S&P, but their weighting is above the overall earnings that they do produce for the overall index, which is something to take note of. Next, we have the performance of the Magnificent 7 stocks within the S&P 500. And we can see that the Magnificent 7 are up 21% year to date, whereas the S&P 500 minus the Magnificent 7 is only up 5% year to date. And then as a whole, the S&P is up 11% so far year to date. So the majority of the S&P 500's return so far in 2024 has actually come from the Magnificent 7 stocks. So take that as you will. But these stocks are very much so leading the overall market up in a pretty big way. All right, now let's move on to the overall health of the consumer. And right here we can see that the household debt service ratio is currently sitting at 9.9% as of the first quarter of 2024, which is actually quite significantly below historical averages. And we can see here that before the Great Recession, this number was all the way up at 13.3%. So the household debt service ratio is actually still low relative to historical averages. However, if we take a look at the flows into early delinquencies, we can say that auto loans are now sitting at 7.9% and clearly uptrending, and credit card debt is currently sitting at 8.9% and is clearly uptrending as well. Credit card debt and delinquencies are actually starting to uptrend quite rapidly. So this is something to definitely take note of and be aware of, because it looks like people are not paying off their credit cards or being able to pay off their credit cards as much as they were recently. And the percentage of people not paying off their credit card bills is spiking quite a bit right now. Moving on to the personal savings rate. Year to date, it is sitting at 3.8%, which is well below the long-term average of 8.5%. This is actually back down to the levels we saw in about 2005 to about 2008, and it's not really uptrending right now. So people are not able to save as much money right now, and I do think that this is probably due to the significant amount of inflation that we saw over the past 3 to 4 years. It's pretty clear to me that people are not really able to have as much disposable income in the current market. And at least anecdotally in my own life, I have heard a lot of my friends and family complaining about how expensive things are and how much less money they have to actually spend and save after they pay all of their bills and groceries, etc. So I don't know if the personal savings rate will start to slowly uptrend as inflation does come down and wages do grow. But at least right now, people are not able to save as much money as they were able to over the past decade and over the long-term average as well. Now, additionally, if we take a look at household excess savings, we can see that the peak was $2.3 trillion in the year of 2021, and it has now been steadily coming down, and people's excess savings is now sitting at only $600 billion, and it is still downtrending. Now, my question is, what happens when the excess savings goes back down to zero? And people's excess savings is essentially gone because currently people do still have $600 billion of excess capital within their savings account. I don't know what's really going to happen when this number finally hits zero, but the trend is declining pretty quickly, and it's definitely going down to zero pretty quick. Moving on to the federal funds rate expectations. So we can say that the Fed funds rate is currently sitting at 5.38%, and it looks like the market and analysts are expecting the interest rates to drop right away. They're actually expecting interest rates to drop before the end of the year, and it looks like they are expecting about 5% interest rates by the end of 2024, and then in 2025 they are expecting interest rates to drop back down to 4%, then back down to 3.9% in 2026. So the market is currently pricing in an interest rate drop by the end of 2024. So take that as you will. All right, moving on to international stock valuations. This chart on the left-hand side shows us the relative valuations of the US market versus the international markets. And we can see that the international markets valuations versus the US markets is actually at a 20-year low by far. So the international markets relative to US markets are looking quite a bit cheaper. And the US markets, in my own opinion, are actually looking like the most expensive market in the world right now. Up here in this table, we can also see the international markets are trading for a forward price to earnings ratio of 13.5, and their 20-year average is about 13. So they're actually trading slightly above their 20-year average. But again, relative to the US stock market, the international stocks are actually looking quite cheap, which is why they are at such a significant low on a relative basis. This next chart shows us global valuations versus their 25-year averages. So right now, once again, we can see that the US is at a 20.5x forward price to earnings ratio, and its 25-year average is down at that 16.5. So it's clearly above its 25-year averages. Then we can see that Japan is currently trading for about 15.6, which is below its 25-year average of about 18. Europe, excluding the UK, is trading right at its 25-year average of a 14.4 multiple. The emerging markets are actually trading slightly above their 25-year average at a 12 multiple, and China is currently trading below its 25-year average at about a 10 multiple. So when we take a look at this chart right here, again, we can clearly see that the US markets are the most expensive relative to their history and relative to the global markets. Japan is currently trading below its averages, and China is also currently trading below its averages. So if any investors are looking for value in the international markets, then maybe Japan and China could be markets to look in for value. Now, this next chart I thought was just kind of interesting. This one shows the US goods imports by country, and Mexico is now sitting at number 1, okay? So Mexico is now the number 1 importer of goods into the United States. And the reason that I think that this is interesting is because a lot of United States and Canadian companies are investing in production infrastructure down in Mexico right now. It's also interesting because CP Rail just purchased Kansas City Southern last year, which makes it the only railroad company to have access to the Canadian markets, US markets, and Mexican markets. So CP's railroad now expands all the way across North America. And with so much production now going down into Mexico, I do think that CP will see massive benefits, especially as more goods are being imported from Mexico into the United States and Canada. Because again, they're the only railroad company that has access to all 3 of these markets, so they're going to be moving around a ton of goods. All right, this next chart right here shows the real GDP growth expected by country. And here we can see that India's GDP is projected to grow by roughly 7% in 2024, and then about 6.5% all the way out to 2029. China is also projected to grow its GDP by about 4.5% this year, and about 3% by 2029, and then the emerging markets are projected to grow their GDP by about 4% this year and all the way out to 2029. So it looks like the emerging markets, China and India, are all seeing massive growth to their GDP over the next 5 to 6 years. Then we can see the US is projected to grow its GDP by about 2.5% this year and about 2% over the next 5 years. So for investors looking for growth, it looks like the emerging markets, China and India, are all offering a lot of GDP growth over the next 5 years. Now, what's also interesting to me is that China's market is currently trading for a forward price to earnings ratio of 10, which is below its historical averages. And China is also projected to see a significant amount more growth than the United States over the next 5 years. So maybe China could be looking quite interesting to investors right now. So overall, I do think that the US markets are looking quite expensive right now. I don't think that the US market is in a bubble or anything like that, but relative to its historical averages and relative to the international markets, the US markets are looking very, very expensive. Based on the historical data, we also saw that when the US markets trade for a forward price to earnings ratio of 20.5, the 5-year average returns afterwards are roughly 0%. So I do think that investors need to lower their expectations for future returns from the S&P 500 because at least historically, over the next 5 years, the market should produce roughly 0% returns annually. Now, personally, I'm going to continue buying individual stocks that I think are looking attractive in the overall market. I am someone who tries to just consistently buy stocks and increase the ownership in what I believe are wonderful businesses, selling for fair prices. And that is what my channel is dedicated to. I'm not an index investor. I don't have any ETFs within my own portfolio. And I try to find undervalued stocks in the market in any market condition because I truly do believe that there is always going to be value somewhere in the market. There is always going to be an industry or a sector that investors are currently bearish on, and there's going to be high quality businesses within those sectors that are offering value to investors. I have also consistently found value in smaller and mid-cap stocks because they don't seem to be as followed by analysts or the overall markets. These stocks are also not included in ETFs, so naturally there is not as much money flowing into them. And I have been able to still find businesses in this current market that are trading for roughly 10 to 12 times earnings and growing their revenues at 20% annually. And those are the types of businesses that I am always going to be investing in, despite what the market is doing and despite if the market is trading for all-time highs. I also recently made a video on my channel on the 5 stocks that I do believe are looking cheap in the month of June. So if you are interested in checking out some of the cheap stocks that I am seeing in the market, at least in my own opinion, then I would recommend going and checking out that video as well. And lastly, just as a quick reminder, if you are interested in hearing me speak on stage in Toronto on June 25th or meeting me in person on the 25th of June in Toronto, then make sure to get your tickets in the description below. There will be a link. It's going to be awesome. I went to this event last year and I met dozens of fans and just investors from all over the world. And it was a really great experience. So I'm going to be doing that event again, and I really hope to see a lot of you there as well. But with that being said, that is going to wrap up the video, everyone. So thank you so much for watching. As always, I truly do appreciate it, and I really hope to see you all again in my next one.